building long-term wealth is greatly aided by having a well-balanced and diversified portfolio. One of the simplest and most effective ways to achieve diversification is through ETFs, or exchange-traded funds. Whether you're into dividends, growth, or specific sectors or markets, there's an ETF for you. In today's video, we'll explore 6 ETFs suitable for every type of investor. The exciting part is that you can invest in all 6 simultaneously. So stay tuned for the entire video. Before we start, please show your support by liking this video and following Moon Investments for more. Let's dive in. Hey everyone, Moon here with another video. We'll start by looking at different types of ETFs. First up is a Dividend Growth ETF, followed by High Dividend Yield ETF, a well-balanced ETF, a growth-focused ETF, a small-cap-focused ETF, and finally an Emerging Markets ETF. Our first ETF, aimed at dividend investors, is the Vanguard Dividend Appreciation ETF, VIG. I favor companies that consistently increase their dividends at a strong rate. This ETF focuses on companies that regularly boost their dividends, enhancing the power of compounding. The yield isn't the main focus here. Instead, it's about companies that can increase their dividends annually. These companies typically grow their free cash flow, a crucial metric for both dividend and growth stocks. Over the past year, VIG has risen by 23% and manages $106 billion in assets. The ETF's portfolio is heavily weighted towards technology, 25%, financials, 21%, healthcare, 15%, consumer defensive, 11%, and industrials, 11%. The top 10 holdings include Apple, Broadcom, Microsoft, JP Morgan Chase, ExxonMobil, United Health, Visa, MasterCard, The Home Depot, and Procter & Gamble, making up 31% of the portfolio. VIG holds 341 positions in total. The current yield is 1.7%, with a 5-year dividend growth rate of 10%, and it has paid a growing dividend for 10 consecutive years. This makes VIG ideal for those seeking dividend growth. Next, we shift to a high dividend yield ETF, the Vanguard High Dividend Yield ETF, VYM. These companies are generally more stable and less volatile, focusing more on dividend yield than growth. VYM has climbed 24% over the past year and manages $76 billion in assets. Its portfolio is primarily in financials, 22%, consumer defensive, 13%, technology, 13%, healthcare, 12%, and industrials, 11%. The top 10 holdings include Broadcom, JP Morgan Chase, ExxonMobil, The Home Depot, Procter & Gamble, Johnson & Johnson, AbbVie, Walmart, Bank of America, and Merck, accounting for 25% of the ETF, which holds 539 positions. The yield is higher at 2.7%, but the 5-year dividend growth rate is lower at 5%. VYM has paid growing dividends for 13 consecutive years, offering higher yield but less growth. Moving on, we have a well-balanced ETF, the Schwab US Dividend Equity ETF, SCHD. This is one of my favorite ETFs due to its balance of growth and yield. SCHD has risen 18% over the past year and manages $67 billion in assets. Its top sectors are financials, 20%, healthcare, 15%, consumer defensive, 13%, energy, 12%, consumer cyclical, 11%, and industrials, 11%. The top 10 holdings include Cisco Systems, Bristol-Myers, The Home Depot, BlackRock, Chevron Corp., Verizon Communications, Altria Group, Texas Instruments, UPS, and Pfizer, making up 41% of the portfolio, which has 103 positions in total. The yield is 3.4%, with a 5-year dividend growth rate of 12%, and it has paid a growing dividend for 12 consecutive years. SCHD checks all the boxes for a well-rounded ETF. Now, let's move on to a growth ETF, which is all about high growth potential. The growth ETF we're focusing on today is the Schwab US Large Cap Growth ETF, SCHG. There are many excellent growth ETFs available, such as QQQ for those interested in options, and VUG from Vanguard. However, for my portfolio, I prefer SCHG. Investing in growth stocks often means higher volatility, but when markets are performing well, growth stocks can yield impressive returns. SCHG has risen by 42% over the past year, significantly outperforming the S&P 500, which increased by about 30% in the same period. SCHG manages $37 billion in assets. The ETF's portfolio is heavily weighted towards technology 48%, followed by consumer cyclical 13%, communication services 12%, healthcare 10%, financials 7%, and industrial 4%. The top 10 holdings include Apple, Nvidia, Microsoft, Amazon, Tesla, Meta, Broadcom, Alphabet, and Eli Lilly, making up 54% of the ETF. SCHG holds 230 positions in total. Although it pays a small dividend of 0.4%, the main focus is on growth. High growth potential can lead to great returns when the market is strong, but it also means higher volatility during market downturns. Next, let's look at a small cap ETF. My preferred choice in this category is the iShares Core S&P Small Cap ETF, IJR. Like growth stocks, small caps can be volatile, especially in high interest rate environments. However, recent trends in the US have shown a shift towards lower interest rates, which is a positive sign for small cap investors. Over the past year, IJR has climbed 24%. However, over the past 5 years, it has underperformed the S&P 500 due to high interest rates. IJR manages $94 billion in assets. The ETF's top sectors include financials, 18%, industrials, 18%, consumer cyclical, 14%, technology, 12%, healthcare, 11%, and real estate, 9%. The top 10 holdings, which account for only 7% of the ETF, include BlackRock Cash Funds, Carpenter Technology, Comerica, Bath & Body Works, SPX Technologies, Robert Half, Glaukos Corp., ATI, Jackson Financial, and Mara Holdings. IJR holds 613 stocks in total. While small-cap companies often don't pay dividends, IJR does offer a small dividend yield of 1.2%. The primary reason to invest in IJR is to gain exposure to small-cap stocks. Finally, let's discuss an emerging markets ETF. My choice here is the iShares MSCI India ETF, INDA. Although I typically invest in US-based companies, I do seek some exposure to emerging markets. India is an emerging market with a rapidly growing economy, and many companies are shifting their manufacturing from China to India. Over the past year, INDA has risen by 17%. INDA manages $11 billion in assets, making it the smallest ETF on our list. The ETF's top sectors include financials, 27%, technology, 12%, consumer cyclical, 12%, industrials, 10%, energy, 9%, and basic material, 7%. The portfolio consists of 175 positions. INDA does not pay a dividend, but it provides exposure to the Indian market. We've now covered 6 different ETFs, each catering to various investment strategies. You can invest in all 6 to diversify your portfolio. We looked at a dividend growth ETF, a high dividend yield ETF, and a well-balanced ETF. We also covered growth, small caps, and emerging markets. Let me know in the comments which of these ETFs is your favorite. If you haven't already, please like this video and follow Moon Investments for more.